Welcome to Technology Deal Structuring. This webinar is brought to you by BGZ Technology in collaboration with Analytic Strategies LLC. I'm Bernie Zuzo, President of BGZ Technology, and I'm pleased to have had the opportunity to produce this webinar. Content for the webinar was built upon the concept of a product's life cycle and how a technology evolves into a product, followed by manufacturing and sales. Anywhere along this life cycle, capital can be raised, but so can cash from technology transactions. This webinar brings those transactions out into the light of day. So let's get started. When you reach the end of this program, you should have insight into these structuring areas: the types of technology deals, their impact on cash, when to use each deal, a helpful template for deal structuring, and a couple of illustrative examples, one for tax credit financing and another for licensing. Then we'll close with a few tips. Presenters today are first Carl Dakin. Carl has been a long-time technology law attorney and entrepreneurial consultant. He is an author in technology transfer and advisor in economic development. Carl is also founder of Dakin Capital. Mark Moeller is a principal at Corridor Legal Partners, advisor in capital formation, and expert in green technology entrepreneurship. Mark is able to structure some very complicated and meaningful transactions. I'm Bernie Zuzo, President of BGZ Technology, practitioner and educator for technology commercialization in both public and private sectors. Carl and Mark, would you be kind enough to provide more background about yourselves?
Thank you, Bernie. I appreciate this opportunity to take my 30-plus years of high-tech startups and to share knowledge that I've gained in doing that. I enjoy the opportunity to speak and teach on these subjects, and look forward to providing some information today that you all find helpful.
Thank you, Carl. Mark?
Thanks, Bernie. I guess at this stage I'd qualify as a serial entrepreneur in clean tech, having founded several companies that are venture-backed, private equity-backed, and a few public companies in the sector. As Bernie said, I also serve as an of-counsel partner, but I also work with the Florida Opportunity Fund.
Thank you, Carl, and thank you, Mark. Today's topic addresses the anatomy of deal structuring. New technologies are often advanced with partnering, collaboration, or licensing agreements. During this webinar today, we will explain when these instruments are used as alternatives to equity investment. We will also identify articles within agreements which define the technology, the project scope, necessary tasks, roles of the parties to the agreement, and also the contributions that these parties make, and also who gets what out of the deal. These essential elements will constitute the core of what makes up the agreement. We will have two case examples. One will be an illustration of tax credit investment. The tax credit can be used to partially finance a deal. The second illustration will be about licensing technology and how licensing can generate cash. These technology transactions and business transactions that we'll be talking about today are all alternatives to equity investment. There really are a surprising number of deals that can be put together. We've clustered them into three colors. The green color focuses upon licensing, collaborations, government grants, the kinds of things where the intellectual property ownership is important in the deal, and there will be some element of a licensing agreement associated with all contractual arrangements that are developed. The red buttons are transactions which involve government loan guarantees as well as customer loans and tax equity financing. So it focuses more upon debt financing. And the blue buttons address equity financing, the various rounds of venture funding through to what most of us consider the grand slam home run, which is an initial public offering. I want to invite both Carl and Mark to provide a little depth on this particular slide now that I've provided the overview. Thank you, guys.
Thank you, Bernie. In looking at this particular chart, you can see, as Bernie said, a variety of different types of ways or different types of deals that could be done. And in every given situation, you may find that several of these are available while several are not. So each case is different, each deal is different, and as you craft and structure each individual deal, you'll want to look at these different alternatives and see if one of them may have a superior consequence to your strategy, whether it's going to get you where you want to go.
Yeah, and I'd add to Carl's comments that overall the message is that while finance can be quite challenging, there's a variety of programs that can help out, and in many cases, as Carl said, you need to pull from a variety of different options to structure a financing that can get you to where you need to be. So having that type of flexibility and variety from all these different sectors can be quite useful.
Transactions actually are a tool for financing. We think of them perhaps more as legal tools, and they are, but they also are instruments for raising cash. This slide once again shows the product life cycle curve from development through introduction, growth, and then maturity. When we look at the cash necessary for activity in the company, we see that this green line indicates the cash that's being consumed for these first three phases. There is no revenue, so the consumption is total development. Cash is not generated until products begin to be sold, and that happens first in the initial distribution phase and proceeds into market penetration. It's no wonder folks have problems starting and advancing a business because the cash need is significant. One of the transaction instruments available to entrepreneurs who are technology based are SBIR grants, a federal grant from about 11 different agencies. This illustration here shows that because a federal grant is made available through technology development, an SBIR Phase 2, sufficient cash is raised to cover the cost of the work. So an SBIR can actually reduce the amount of cash necessary for follow-on development. Carl, I'm going to ask you to comment on this, but I'm going to go to the next slide before I do. Actually, I'm asking both of you to make comments, but I want your two illustrative examples to be shown on this graph. This graph is showing again the valley of death, where no funds come in. It needs to be financed by the original entrepreneurs, theoretically, where there's a licensing agreement. But then if you also use your tax credit transaction, you further reduce your cash need in the future. I'd like for both of you to talk about that issue.
Thank you, Bernie. As Bernie was stating, during this life cycle, until you get to the point where you're actually selling a product for the first time, somebody has to come up with all the cash that's necessary for people, equipment, facilities, and any of the development work that's going on. One of the sources for this cash may be licensing. And licensing is where you take the entirety of all the market opportunities that's represented by your innovation, and you break it into different fields, where one may be like the automotive industry and another one may be the aerospace industry. And what you can do is you can license away one of these fields, keeping everything else, and use the money from that license to pay for the development that you need to get through these particular phases. So a license can occur very early on, even at the original idea of the particular innovation. But a license can occur during the entire life cycle, all the way up to a point where you're already in the market and selling. So at any point along that path, you may generate more cash for your business, which you can then use to address your cash flow needs for all the other applications and markets for your particular innovation. Or it may support you moving into yet a second or third innovation and giving you greater flexibility and agility to address what you've learned and to go into new markets.
And in the case of a tax equity transaction, which is shown on the slide, the simple economics are allowing a company to monetize a future stream of tax credits. So the government, as a matter of tax policy, promotes a certain activity, whether it's investment in technologies that generate renewable energy or tax credits from the generation of actual and production of renewable energy, to other examples, some of which we'll talk about in detail. Those activities of the company generate a tax benefit, but probably aren't of tremendous use to the company during early stage financing on what we see on this continuum. And so a cottage industry has developed where these tax credits are effectively sold, although the tax structure is such that you cannot directly sell them. But you get the economic benefit of having sold those tax credits to a group, usually a large bank, that can use those credits now. And the economic result to you as the company is that you end up with what is effectively, at the end of the day, a grant. So tax credits created by the federal government end up being money invested in your company in a non-dilutive way. And what I'd say again is that in structuring these, you can effectively couple other transactions along with tax equity or along with a licensing transaction to provide a larger share of the financing.
Let me advance this to the next slide. We've got a list here of about a dozen or so transactions, from material transfer agreements and NDA, non-disclosure agreements, to licensing agreements, partnering agreements, tax equity financing. Carl will talk about licensing with his illustration, and Mark will talk about tax credit financing. There's another slide here with additional transaction on them, but we'll focus first on this slide, this first of two. We want to put each of the deals into perspective. We will take a look at the corporate growth stages, which you saw previously as the development stages, startup, pre-revenue, the marketing stages, product rollout, and then market penetration. Then beyond that, it's rapid growth and maturity. We want to let you all know when each of these agreements is appropriate to use and when it's not likely to be justified. We also want to differentiate each of these agreements so that you can see why there are so many wonderful opportunities and what the characteristics are, so that you'll better know when to choose them. We would also like for you to get some insight as to what the most general applications of each of these instruments are, and we expect that from your perspectives, you want to know, as an entrepreneur, what will you need to contribute to the deal. So I'm now going to turn this over first to Carl and then to Mark, and ask you to give further insight to what this matrix is telling our audience and us.
Thank you, Bernie. I will be talking about a license agreement as one type of transaction. And as Bernie indicated, a license agreement can work through all the different stages of a product life cycle or through even the life cycles of a business. And so as it progresses through the different stages, licensing is always an option that can be considered in addition to or as an alternative to other types of deals that may be done. A license commonly is used when you want to take a specific innovation and you want to hand off responsibility, like handing off the baton in a relay race, to another organization who will then take that innovation and carry it to the marketplace. And in structuring that particular deal, you'll be primarily talking about who owns what kind of rights are granted with regard to taking that innovation into market, and then what markets are going to be included within the grant. So are you going to give somebody all rights to all markets, limited rights to certain markets? Is it going to be for a fixed period of times, or are there other constraints or limitations upon the right to commercialize or exploit that innovation in a particular marketplace? And when you look at the general applications, typically the description of the grant will be for a specific product or type of application in a particular market. Sometimes you'll have broader, more far-reaching types of grants that include further research and development, but most licenses are to take a widget and stick it into this market where the company has production and distribution capabilities. From the perspective of the business that has the innovation, an SBIR company or somebody who came up with the innovation, what they typically are going to be doing is making a grant of legal rights, which is why in our last session, intellectual property, we talked extensively about you can't transfer or sell something that you do not own. So if you haven't established your trade secrets, patents, copyrights, trademarks, and so forth, you're not going to be in a position to grant those rights as part of a license. And then after the license is granted, there's this ongoing relationship between the innovation company, the licensor, and the buyer or licensee of that particular set of intellectual property rights. And it's very common for the innovation company to provide ongoing support. One is to transfer the knowledge that is held to the licensee, but also to often engage in further refinement or development of that innovation to make sure that the product is working and that it's demonstrating optimum features and characteristics that are desired and needed to bring that into the marketplace. So the license agreement is a very flexible tool. It can be used, as I said, throughout the life cycle of the product as well as the company. And it is something that requires understanding and control of intellectual property rights in order to structure the deal and then turn that around and make it fit into a specific marketplace.
Thanks, Carl. So the differentiating feature of a tax equity financing is again, it's the monetization of an activity, a future tax credit stream, which is generated by the specific activities of your business. And again, in the clean tech sector, the good news is there are several tax credits which have been created to incent businesses to do the types of activities that many clean tech companies do. And so that's the good news. By allowing the monetization of that future stream of tax credits, what you receive as a company is effectively non-dilutive equity, and that means you're not giving up a piece of ownership of the company in exchange for these dollars, which is, as Bernie mentioned at the beginning, kind of the most ideal way to end up with capital. But it also requires that there's somebody out there who is willing to buy those tax credits, and in recent years that's been a problem with economic collapse. There's not as many companies, there's not as many large banks that have a tremendous amount of taxable income that they want to offset with present tax credit production. So we're going to use some examples here that are not only examples of traditional tax credit, tax equity financing, but we're also going to use some, if you move to the third category here, the third column, that identifies some of the available tax credits, the investment tax credit, the production tax credit, and the new markets tax credit.
Thank you, Mark. Before we go to the next slide, I do want to highlight one other type of transactional deal. It's a partnering deal that involves often the federal government and a private company, or it can involve multiple companies. The authority for this kind or these kinds of transactions comes from a 1984 National Research Act, which permits companies in the United States to collude on the development of technology. They are not permitted to collude on the development of end-use products. This is not a well-known law. It's not a well-known resource. And now that we are advancing from domestic competition to international competition, it's crucially important that more companies find out about the permission they have to actually collude on the development of new technology. You can see that this type of partnering is used in the earliest stages because it deals with technology development and technology advancement. The differentiating feature of CRADA's cooperative research and development agreements and joint sponsored research agreements is because the parties to the deal share cost, and yet they get access to the intellectual property that is developed for specific predetermined fields of use. So they do not need to finance the entire technology, and yet they can use the entire technology for predetermined applications. And when this type of a partnering agreement is put together, it is crucial to define the roles that each participant will play. These partnering type of instruments, as I had mentioned and want to reinforce, are used, at least the ones that are based upon technology, are used for technology development and advancement. There are other kinds of partnering agreements for product development. Evaluation can also be part of these CRADAs and joint sponsored research agreements. What does the owner contribute? Well, the owner is going to be each of the participants in the group. Some will contribute intellectual property, others may contribute specialized labs and equipment, others may contribute a high level of expertise specially focused on this area, others may provide some in-kind contribution, which means they may have developed something that had a special use at the time. They're going to make that available to this particular project as a resource. Partnering agreements for technology development are very powerful. They are a significant answer to financing early stage development. We will advance to the second slide in deal structuring. The same matrix, only more deals. I'm going to ask Carl to continue and pick one of these or more if you want, and it gives some insight to a particular kind of deal. And Mark, the same for you, if you'd like to pick one of these and provide further insight.
Thank you, Bernie. I will speak briefly about seed funding and put that in the context of some of the other choices. As you're looking for money to cover your early stage development of your innovation, one of the places that you may be able to go to is to have people invest into your business or organization. And ordinarily, at a very early stage, this is called an equity investment, where you're giving up a percentage of the ownership of your particular business. And although all cash is welcome, adding a person to your business as an investor, it's no longer solely your choice on how you get to run your business. You now have to compare and contrast your strategy with your new partner. And quite often there is not complete harmony between the investor and the business. And this creates tension and conflict as the business goes forward. So in looking at seed funding as one source of money that can come into the business, obviously if you contrast that with licensing, where you have transferred away a portion of your technology or innovation you still hold 100% ownership of your company. You do not have a partner who you have to answer to or who you have to reach consensus with in developing your strategy. So doing a compare and contrast on different styles of getting early stage money into your company, licensing is superior because you do not get into these equity ownership type of structures like you would with seed funding. I also would point out that in today's capital market, early stage money is extremely difficult to come by, and more and more investors have taken later stage investing, more conservative positions where they want to see the technology advance to a much greater point where you have even early sales before they want to put money into a company. So if you can get seed funding, it may be very good for you, particularly with the right investors. But at the moment, seed funding is a little bit difficult to come by, and it may be easier for you to find licensing revenue from licensing away one or more applications of your particular innovation. Mark?
Thanks, Carl. You know, I'm going to highlight a few that have been very significant in the clean tech sector in the last few years and are likely to continue to be so for a little while. One is the government grant, which can be state and federal. And we're going to show some examples of a company that has obtained both in the course of their project development. And you might think of a grant as a gift from the government. It doesn't dilute your ownership, so they don't obtain an equity position in your company for it, and you don't have to pay it back. But the other one that I'd highlight on here that has played a tremendous role, but the future of it is a little bit uncertain, is the government guaranteed loan. And so the government guaranteed loan affords the ability for the company to go out and get a loan, and the government provides a credit enhancement on the loan. So the government, either typically in the clean tech space through the U.S. Department of Agriculture or the U.S. Department of Energy, agrees to repay a certain portion of the loan, and many times it's 70 to 80% of the loan in the event that the company defaults. So especially in the last few years where you've got in the clean tech sector projects in biorefineries, bioenergy facilities, utility scale projects that have a tremendous capital need, and you have an atmosphere where lending simply isn't happening at the scale of historical levels, especially to new or unproven technologies. The government guaranteed loans have played a huge role in successful finance. But I also have to highlight that that role going forward is at least questionable due to some of the recent high-profile failures of companies that have received these loans or loan guarantees, the best example of which is the Solyndra transaction in California in the solar sector.
Thank you so much, Mark. This is a template to identify issues in the articles which may appear within any given agreement. I'm going to turn this over to both of you for you to provide an overview as you see fit, and also pick representative articles in the agreement, one or two, that you think are illustrative of the deal-making process. Carl, would you be kind enough to go first?
Thanks, Bernie. As you look at this particular template, this looks like the outline of a classical deal agreement. Each of the captions that are presented here represent something that you would expect to see in the contract, and which will describe a particular thing that needs to be there. I typically take the contract and treat it as a process where you want to start at one point and end at another point. And all along the way, each of these particular items represents a stage or step in that process for which one or both of the parties to the contract are responsible. One of the ones that I think is very important here is the one on prior authorities. And what is meant by this is that quite often in the development of a new innovation, there are two or more individuals or organizations involved. And quite often the ownership of the technology has not been well defined to this point, because everybody is kind of working together, focused more upon getting the technology to work, and suddenly they're at a point where they want to do a deal. Well, at that point, they need to sit down and they need to work out who owns what. And if they cannot come up with a crystal clear description of the ownership, then they need to, in effect, join those together or treat them as though they're merged like a partnership, and say that if this technology is sold, they're going to share revenues in a particular framework, and then they're going to set up their IP so that the ownership is not something that can be disputed later down the road. This is, again, a kind of a preliminary stage-setting thing to be prepared then to transfer or translate in a license ownership over to a licensee. Mark?
I would point out on the provision regarding exclusivity. You may, as a clean tech business, have some applications that are more traditional market applications. An example would be maybe you've got an oil from algae type company, or you're generating proteins from microorganisms, and what you're interested in is the oil production, and somebody else might be interested in the protein application, and that's a traditional business, and you want to license out that field of use. That will always come down to a negotiation of exclusivity, and to the extent that you allow that party to exclusively hold those rights and move those forward commercially, and you're dependent upon their actions and not yours to produce a royalty stream or to produce some type of earn-out situation, you do not have to give up exclusivity in perpetuity. You can have milestones that party needs to achieve in order to maintain exclusivity, or else it becomes non-exclusive or it reverts back to you. So that would be an issue where all these topics are obviously negotiable, and that would be one that you would want to focus on.
Thank you, gentlemen. Mark, you're up at bat. Would you kindly explain to us the intricacies of the tax equity financing? I know that some of us can't wait to hear who contributes what, who does what, and who gets what out of the deal. So let me give you the pitch and have at it.
Okay, well, hopefully I won't whiff. So who gets what in a tax credit deal? The company, are taking a tax credit stream that you qualify for. And again, in the clean tech sector, there's often several. And you're, again, effectively selling that to somebody else because you need the money now and they need a tax break now. And what you are giving away is your right to those tax credits, because if you held on to them in the future, you could use those as a company to offset your own taxable income. And some companies elect to do that. They decide that the value of those credits to them through time is more valuable than cash now at a discounted price. So some companies elect not to take equity, but effectively it's an option that we want you to be aware of, and it can end up with early stage cash that can be more important. The tax credit partner, they get, of course, that stream of tax credits for cash, and they get those credits at a discount to market. So a tax credit offsets tax liability dollar for dollar, but they don't pay you $1 for that credit. They pay a discounted price, usually between 80 cents, and in the case of the example we're going to show, less than that because of a time value of money cost. So they actually buy $1 of tax credit offset for at least 20% discount to the value of that, and they end up with the tax credit. In many cases, there's a deal facilitator. And under a new markets tax credit, which is the example we're going to show in the next slide, that deal facilitator is a creature of Treasury Department regulation called a community development entity, or a CDE. And new markets tax credits, the reason that we've chosen to present this one to you is to show the flexibility and the variety even within some of these categories. New markets tax credits have nothing to do with the production of renewable energy. What they do have is they are a tax code driven promotion of making investments in low-income communities, and oftentimes, especially when you have a utility scale project, a biorefinery, a power plant, a solar array, many times those are going into areas that will qualify as rural areas, as low-income community areas that can generate these credits, and you can find that out by simply going to the Treasury Department's webpage, and the the subset of the Treasury is the Treasury Department is the CDFI, and you can put in the physical address for the place where your project is set to be built, and it will tell you whether or not you qualify. And so these CDEs are actually private entities that are set up from the largest of banks down to just small community development type companies that are set up, and they request allocations of these credits for investments in low-income communities from the Treasury Department, and the Treasury Department allocates those. So when you go out to find these deals, and these CDEs are listed on the internet as well, also on the CDFI webpage, you find these parties and they let you know whether they have tax credits and whether they're interested in using those tax credits to support a tax equity deal for your business and your project. Can we go to the next slide, Bernie? We're going to point out the areas of this as quickly as possible that show the economics of a new markets tax credit transaction. In this case, it's being enhanced by a traditional loan. And you can use that loan to both receive a below-market interest loan on favorable terms, and also to use the cash from the loan to generate additional tax credits. But let me focus on four critical parties that you need to pay attention to on how the deal works. The first one is at the bottom, the project developer, and that would naturally be your company. To the left, you have the CDE, which I was just describing, which is the deal facilitator that has an allocation of federal tax credits and is looking for deals to put those into. The next is the traditional lender. But let me make a note that that's the most common, is to have a traditional lender actually make a senior secured loan as part of the transaction. But there's also tremendous variety on this option as well. This loan could be a government guaranteed loan by the DOE or the USDA, to use an example from the prior slide. It could be a bond deal where there's appetite for higher risk profile, more so than a traditional lender. And there's some groups that have done tremendous work, Stern Brothers being the best example, to show the variety of loans and lenders and types of credit enhanced transactions that you can use for that loan. And then the last party is the tax credit investor. And historically, again, these are big banks, investment banks, that like these types of deals. So those are the four parties. The blocks in the middle simply facilitate the structure that you need in order to allocate those tax credits to the tax credit investor, because again, the tax code doesn't allow you to just sell them. You have to be in partnership, and these partnership structures simply facilitate the deal. So don't focus on that for purposes of the level of detail that we're talking about today. What we've got here is the generation of $10 million in order to generate $3.9 million in tax credits.
Thank you, Mark, for walking through that. It is complicated. Carl, go ahead and please address the licensing agreement.
What we have here is, again, a chart that lays out the primary components of a licensing agreement. Starting on the left with the parties, usually you have a licensor and a licensee. The innovation company being the one who is going to make a grant of intellectual property rights to the licensee, and that is how the agreement is classically framed, as a legal instrument where you're transferring a portion of the title or ownership rights in an innovation over to a company who is then going to take that innovation at whatever stage in the product life cycle you're at, and will then continue to work with that to bring it to market. The licensee typically is going to pay a cash fee at the time of the transaction. Now, this may be a lump sum cash fee which represents the perceived total net value of the innovation in that market over time. And even though this example, we may sell millions of dollars of product in the marketplace, that's going to take place over a period of years. So there has to be a discount back to today for the value of money. There will also be a discount that will take place based upon the risk, because it's not certain whether or not those sales will occur. And depending upon how early you are in the life cycle of the technology, these discounts can be very, very severe. If you're still in an idea, you have only a bench prototype, the price you're going to get is far, far less than you're going to get if you're able to carry that innovation further down the product life cycle on the chart that we referred to earlier. And that's because the risk is disappearing, the capital required to move it through this portion of the life cycle is being reduced. And so the longer you can carry it, keep control over the technology, the higher the price you're going to get. But from a strategic standpoint, you may not want to do that. You may have other things that you want to chase as far as other opportunities. And from a cash flow, you simply may not have the money to carry the innovation through the life cycle. So licensing away early may be your best choice. When you do the deal, you've got a choice between cash. You may also get stock or other types of compensation from the licensee. You want them to be able to pick up this baton, carry the baton around the rest of the racetrack to finish the race and bring the innovation to market. So the licensee needs to be competent in what they're going to do. They have to commit the resources to make it happen. They have to understand what they're doing. They have to be positioned in the marketplace in order to make the innovation everything it can be to fully realize its value. A lot of times you're going to see where the licensee doesn't have the commitment to do everything that you would like for them to do with your innovation. They may even set the technology on the shelf for a period of time because they don't have a sense of urgency. They don't need to generate money out of this tomorrow where you would like to see some royalties tomorrow. So as the license agreement is put together, this relationship between you as the current owner of the technology and the licensee has to be looked at as kind of a partnership or teaming in terms of time. You've got the first leg of the race, they have the last leg of the race, but you want to make sure that they're the right person at the right time with the right resources and the right motivation to aggressively move that technology into the marketplace. If all these things are put into the agreement so that there are clear understanding of what the licensee needs to do at each stage or in order to realize what you want to have happen out of this agreement, and then if they fail to do that, then you have the opportunity to take the technology back and find somebody else to team with or do it yourself. So all these things need to go into the agreement as you start figuring out what the relationship is between your company and the person that you're going to license to. Bernie, could you go to the next slide? The example that I'm using in today's program is kind of a blended illustration of a number of technology transfer deals I have worked with. But here we've got ABC Company is the company who owns the technology, and in this case the technology is a piece of software that allows calibration of oil drilling equipment in the field. If you can imagine putting a hole down 30,000 feet to try to find a pool of oil, and your calibration software is off, so you're maybe a half-mile away from where you intended to be, it's good to have some software helping you point the drill where you want it to go. So a very important piece of technology useful in the oil industry, and in particular with the drilling they're doing in the United States and in all kinds of cross and horizontal drilling. This becomes even more important. In this case, somebody came to this company and said, we'd like to buy you out. We like what you're doing. The product's doing well in the marketplace. It's what we would buy to complement what we want to do. So we just want to buy you out. But the company, ABC, realizes that this particular technology is not only useful in the oil and gas industry, but it also could be used to calibrate tooling in other industries, from things that may occur in aerospace, it may occur in metal fabrication, It could be used in a variety of testing equipment, and the company that wants to buy it is only going to sell it in the oil and gas industry. So they're only going to pay a price for the technology that represents the market in the oil and gas industry. All these other potential applications they're not going to pay for, because they're not going to realize any value out of that from selling it. So ABC decides, instead of just selling everything, which is a sale, is to sell all rights, is to do a license agreement. And in the license agreement, they're going to carve out a field of use, or a market niche, or vertical market as it's sometimes called. And they say, we will grant to you the right to use this software, but your use is going to be limited to the oil and gas industry. So at that point in time, it's going to be very necessary to talk about what is the oil and gas industry and what's not in the oil and gas industry. If somebody is doing something in a related field like drilling for water, that would be excluded from this license, and it would be held back to license to maybe another company who's only in the water drilling industry. If it's going to be used in aerospace and anything, these are all excluded. So the grant of rights within the framework of the license agreement is going to be very specific upon what industries are going to be impacted. Now, sometimes it's a common mistake in a license agreement to focus too much on the technology, and instead of framing the entire agreement around a market opportunity, around a specific field of use, it may refer too specifically just to the technology and not do a good job of talking about the markets. And that's a quick way to get into trouble, because there will be confusion somewhere down the road as to whether or not the licensee has the right to use the technology in a particular market. And as the technology shifts or market shifts, then this confusion will typically lead to a problem at some point. In pricing the technology, again, there's a question that's going to be raised. Are we going to price it based upon prior sales, or are we going to price it based upon future sales? And with a particular technology, if it's never been sold into the marketplace before, any projection of future sales is speculative. Nobody really knows what it's going to be, and this is a point where negotiations can be most fierce, because both sides have their crystal ball on the table, are trying to anticipate how many sales are going to go out into the future. Now, this is often addressed by doing a pricing structure involving royalties, where there will be, as I said, a minimum license fee paid at the time of the transaction, and then there will be a sharing of revenues over time based upon future sales. Again, more complexity enters the picture, because these future revenues have to represent a percentage of the profits that the licensee would earn. Otherwise, they wouldn't make any money, and there'd be no benefit from this. So understanding exactly what kind of costs are going to be incurred, what kind of profits may be earned, are all critical to coming up with a price point within a royalty and allowing that to go forward in time. Bernie has now flipped to the specifics within the licensing agreement, and as you can see, again, as we talked about earlier, these are all the common terms that are found within a transaction. And in this case, each of these items need to be addressed. And when you were looking at Mark's presentation earlier on that type of a transaction, you may have thought that, wow, that's really looks hard, that looks complex, I don't know if I want to do it or not. Maybe I should do a license agreement because that's a lot simpler. But at the end of the day, if you do a license agreement correctly and you address all these issues which are in the licensing agreement, you're going to get to that same level of complexity. You're going to need to have that same level of knowledge and understanding, the ability to see how this technology may enter the market over time and how that impacts both you and the licensee. So again, at this point, it's very important to understand these issues, to sit down and work your way through to make sure you understand everything that will go into the agreement that's going to frame the relationship, which is going to control how this technology is going to be commercialized, and then how you're going to benefit from that commercialization.
Gentlemen, I would like for each of you to take one challenge and one tip and speak to it for about a half a minute, and we'll move on to the next slide.
Okay, thank you. I'll start off with setting a fair royalty. One of the things you'll hear often in setting a royalty is that this is the market or this is the industry royalty rate. And at the end of the day, that's not really true. A royalty represents a percentage of the profits that may be earned on a particular innovation. And from one innovation to the next, these profits can vary radically. In certain cases, a royalty rate of 1% may be too high or too low. And in another situation, like in a medical device, a royalty rate of 12, 13, 14% may be quite reasonable, because there are high profits involved in selling that particular product into the marketplace. So in setting a fair royalty, I typically use a rule of thumb of 25% of the net profits would be a good royalty rate. And from that, then I negotiate as best as I can if I'm selling to raise the royalty rate, and of course if I'm buying to lower the royalty rate. But figure out what the profits are, and then do a fair splitting of those profits between you and the seller. And if you don't understand all the cost that the licensee is going to incur in bringing it to market, you need to know that. Otherwise, you can't negotiate well with them. Bernie?
Mark, would you kindly pick one of these challenges?
Sure, Bernie. The obviously the slide itself is intended to emphasize the point that Carl was making. You can slice and dice a core technology if you're a technology company or an innovation company in a variety of ways, in a variety of different markets. And going back to the point I made earlier, which was prevent the buyer from sitting on the technology, to the extent that you do elect to license out or sell or otherwise rely upon the efforts of a third party to take one of those applications and run with it, focusing on the metrics that are required for that party to keep exclusivity or to keep the technology itself is really the core focus of what I would encourage you to look into when you do those types of deals.
Thank you, Mark. You two are given the opportunity to show how artistic you are as deal makers. But unfortunately, we don't have much time, so each of you, again, please pick one of these bullets and speak to it.
With regard to structuring a deal, the thing I would suggest is to be highly creative in your own right. You've spent a lot of time bringing your innovation to this point. You're trying to do a deal, but don't get all caught up in the money. If the person who's buying your technology, who's licensing your technology, has other things of value to you, ask for those as well. If you can use their lab, sit in their booth at a trade show, borrow their personnel, look into their data library, anything else that they have that they can give you that doesn't cost them anything is something you can add to the deal to make it a sweeter deal for you.
Thank you, Carl. Mark?
Yeah, my suggestion when you're dealing with large companies that have cash and you need it, one thing I would suggest that you focus on is many of these larger companies will try to put your company in the position of being a fee-for-service provider. So you're just simply getting a fee to help them advance a project. It nevertheless is very important to structure the style of the deal whenever possible that the assets are on your balance sheet, not theirs. Because only in doing that do you put together ongoing enterprise value that's going to allow you to build a company that somebody else is going to buy. Fee-for-service companies typically don't sell or exit with much of any enterprise value. So focus on the style of the transaction and try to resist ever being positioned as a fee-for-service provider to large companies, unless that's your business model.
Thank you, Mark. That's a real challenge for R&D and engineering development companies. To sum it up, the objective for today was to raise the awareness about entrepreneurial transactions and to provide some insight as to how they're structured. And in doing so, present some applications and options along the full development cycle. The significance for raising awareness of transactions as ways to move technology forward is done to show that transactions are an option to venture capital, and they provide the benefit in not diluting ownership. I'm Bernie Zuzo and want to thank all of you for attending and being part of this webinar. I'd like to thank Carl Dakin and Mark Muller